To the end of the press conference, the last few questions. I can see one of Rand Squawk's analysts at the moment just asking the last question. But overall, you can see the pound distinctly lower here from where we were prior to the announcement. We've seen a repricing from around the opening print of 132.30 all the way down to the 131 handle. And so we've remained around those lows. So overall, you would think, just looking on the price action alone, if we look at this on a minute chart, this is the spike that we saw. Obviously, you can take away now in hindsight, this was a dovish interpretation. So explaining the way that the event unfolded, first of all, in terms of that sequence of how the market was going to react, obviously it was the hike, no hike, which took precedent first. And obviously they chose to hike. So one of the important things here, just to look at UK interest rates, is this is the first rate hike in over 10 years. But looking at it more short term, in the last 12 months, this reverses then the emergency cut that was seen in August, which was immediately after the EU referendum. And so to protect too much of a negative impact after that surprise event last summer, the Bank of England cut rates to 0.25%, and now we're back to that level. Much long term though, if we start looking on a max rate, obviously pre-financial crisis our neutral rate was 5%, so this is just a very small incremental change, taking it back what we saw and back to where we were for the majority of the post-financial crisis era. So the first move was up, obviously confirmation of the fact that they hiked, but then the vote split was key. And what we saw there was a 7-2 split, so two people, Ramsden and Cunliffe, still were of the view that now should not have been the time to hike, but 7 of the other MPC decided that now was the time to lift interest rates. And so both of these occurrences are hawkish in that sense, certainly the hike and then the 7-2, but this event was going to be volatile always because of the fact of different things that you needed to monitor, i.e. then after those two events, the minutes, the quarterly inflation report, we've just seen conclude now the press conference. Now the press conference really has been an absolute non-event. So the real big thing that shaped the market reaction here was a couple of the comments that came from the QIR, which comes out 4 times a year. And the next one is not going to be seen till February. Now, the reason why the QIR is key is because it gives projections forward-looking for the next 2 years of where they see things like GDP and inflation. And let me just read to you a couple of the comments that came out of that. So, policymakers omitted language from previous statements saying that more hikes could be needed than financial markets expect. So that hawkish comment, which materialized back in September's meeting, has now been eradicated and taken out. So that very hawkish statement removed. That implies that officials are comfortable with pricing for 2 more quarter point increases, roughly one by late next year and another in 2020. So when we talk about a sequence of rate hikes, what we're talking about here as a time frame is a hike now, another hike in a year's time, and another hike in 2020. Incredibly gradual way of hiking interest rates. And I think that's one of the main things that the market moved on in such a dovish way, is because if you start looking at this chart here, this is the market implied path of UK short-term interest rates. And this is quite a good graphic because the red line is the UK and the Bank of England. And so the dotted line to the firm line going centre right is identifying the August to the November QIR report. You can see across the 2 major central banks here in UK and the US, the rate trajectory curve has got steeper, but if you look at the projected curve of rates over time on the axis on the bottom, incredibly slow, not looking at reaching 1% in UK rates until 2020. Compare that to this sequence of staircase raising, if you like, from the Fed, and you can see why the market's looking at that in a lot more dovish way than what we've seen set as a precedent from the Fed and what would be more traditional the way central banks like to hike. Some of the other comments that I think are very notable here have been on CPI. The Monetary Policy Committee still expects inflation to peak above 3% in October. The effects of rising import prices on inflation, though, will diminish over the next few years. So after it peaks in next month's CPI report, that is the top of where this inflation is going to hit before it starts to revert back to their target in the long run. On the balance, inflation is expected to fall back over the next year, and conditioned on gently rising past the bank rate implied by current market yields to approach 2% target by the end of the forecast period. On Brexit, they said their projections are conditioned on an average of a range of possible outcomes in regards to the situation, and have been based on a smooth adjustment, but they were quite vocal in the fact that actually the outlook remains considerable risks to that outlook because of Brexit, which includes the response of households, businesses and financial markets to developments related to the process of the EU withdrawal. So they are quite downbeat about the prospects of this political uncertainty that we have at the moment. And then finally on rates, and I think this was another key take home from the minutes, all members agreed that any future increase in bank rate would be expected to be at a gradual pace and to a limited extent. And so, as such, the overwhelming move here has been a dovish hike, is the terminology I'm sure you'll see coined in the press tomorrow. And the pound has remained lower in the aftermath of the event. You can see here, technically, we had a test down at the psychological 131 handle and the immediate move to the downside just at around the beginning of the presser. We have stabilised since, but still about 125 pips lower from where we were from earlier this morning. But the lows that were seen in play at the late October time, just sub there at 130.88 in the futures, and certainly that low seen at the beginning of October is still holding up for the time being. So overall, the Bank of England have lifted rates, but their communication about when is the next rate hike coming is basically there is going to be more hikes, but not at anywhere near the same pace of what we've seen from the Federal Reserve. We're talking more about one at the end of next year, one in 2020 type time frame. Obviously, there's going to be, in the interim period, what will be interesting come February, which is the next time they release their updated projections. We should, I say that lightly, we should have clarity on the transitional deal between UK and Europe, and by then we should have at least some clarity politically on about the outlook for the trade talks going forward for Brexit. But very volatile event, as we were expecting, but overall a dovish interpretation. The communication was key after that initial confirmation of the rate hike and the 7-2 split. Alright, thank you very much. Have a good afternoon.